Thank you very much for joining us. Those of you who are here on time, that's great. If you're coming in late, you won't know this, but this will be taped and you'll be able to view it on our website at a later date. So if you miss anything in the beginning, it's mostly the introductions, and that's fine. We'll catch up later, okay? So today we are going to talk about getting inside the mind of a business lender. So what does that mean? It means a business lender has certain types of things that they're looking for in order to lend to small business owners. That's our main focus today. And as a former business lender, I worked in the big banks and I was a commercial lender for many years. So I'm going to give you some insights as to what they think of, and that will help you prepare your loan application to hopefully get to an approval or get to a yes. This workshop is only the tip of the iceberg, and I want to make sure everybody knows that we are here to help you individually. So if you have specific questions about your particular business and how it can be made ready for a lender, I suggest you talk to an advisor here. Our services are of no cost, and it would really be to your advantage to make an appointment and talk it through with one of us. We are all very well connected in the lending community, both with traditional lenders as well as online lenders. So I think you will find it worth your while to do so. Go to the next slide. So what is the Small Business Development Center? For those of you that don't know, we are an agency that is funded partly by the Small Business Administration, which is federal funding, and the state of New York, which is state funding. And we're hosted by educational institutions across the state. Most of them are SUNY schools, like here at Stony Brook University, but we also have private schools which house us, like Pace University in the city, and Baruch and Columbia. So we are thought of as kind of a quasi educational center where we're helping people grow their small businesses, which is great for the economy. So everything we do is trying to move the needle and get people to where they want to go and create jobs and invest in our economy so that all of us in New York State, as well as the whole country, because the Small Business Development Center is not unique to New York. There are small business development centers in every state in the nation, including Puerto Rico. And so we are well known. We've been around, by the way, for 40 years. We just celebrated our 40-year anniversary, and we've come a long way. And we're always trying to keep up with what small businesses need in this economy that we're in, which is always changing, right? So as a business owner, you want to be curious. You want to learn all the new things that can help your business grow and succeed. We not only do counseling, we also do a lot of workshops like this one. Some of them are given by us because many of us have specific subject matters that we're very expert on, if you want to say it that way. And then we also go out to the outside and we bring in business owners from the community that have that relevant current information that we know we need for our small business owners. And they come in and do workshops pro bono for us, but they get a lot of visibility. And then you also get to see people out in the community that are maybe doing digital marketing or attorneys or CPAs, all kinds of subjects that we're really thrilled that they donate their time to get out there and talk to all of us. So I welcome you to check out our workshop schedule. We tape our workshops, so those are also on our website. Really take advantage of all this information. It makes you stronger, more confident in what you're doing. So what do? We do a lot of business planning. I think what I enjoy the most about the job is meeting small business owners and helping them strategically plan where they are and where they want to go. So what is the resource? What are the resources and opportunities that exist for this business? I also do a lot of startups, which is that people come with an idea and they want to get it going. The best startups, the most successful, are people who have some experience in that type of business. That's what most lenders like to see. because when you're in that culture and you know that industry, you're obviously going to be a lot more effective when you start your own business. So a lot of people start businesses as a side hustle and keep their day jobs, which I recommend if you need that money to survive. And then when it starts gaining momentum, you jump off your full-time job and you jump into a full-time business that you own. There's a lot of romance in owning a business. A lot of people think it's just like all, rainbows and unicorns, if you will. It's all going to be great. But we try to help people see the reality of owning a business, because you may be good at what you do, but you may not have management skills to run a business. You may not know the bookkeeping part. You may not know the digital marketing aspects, which is super important nowadays. So we help people, we sit down with them and try to understand what they're looking to do. We're not all about being a cheerleader. We're more about being objective and looking at what the opportunity is and pointing you in the right direction and staying with you until you feel that you're on your own and you don't need us anymore. But I have to tell you, a lot of our clients come back to us as they're growing, as they're looking to add on new locations, as they're looking to buy businesses. So we stay with our clients and know many of them for many, many years. We are also residents here, so we know our communities. I, in particular, cover a lot of the East End of Long Island on the North and South Fork. So that's kind of my specialty. That's where I live. I know that area really well. But of course, we can deal with people anywhere. And if you're going to move your business into another part of New York State, guess what? We have advisors in those parts of the state that can help you as well. So it's a tremendous resource, and I just encourage people to take advantage of it. Costs nothing. So please take advantage. These are some of the things we do. Business planning, accessing capital is what we're going to talk about today. Industry research. Did I tell you, we have librarians sitting up in Albany that will put together custom research for you in whatever you want. Maybe you want a list of businesses to target. Maybe you want to know what your competition is. What is the industry trend in what you're doing? You want to get ahead of the game. You want to be the first mover in a particular industry. We can help you with that. The startup process is a lot of what we do. How do you actually get going? What kind of compliance things do you need? Do you need insurance? Do you need to be an LLC or a corporation, or maybe just a sole proprietor? Financial management. We actually have a CPA advisor on staff here. Not that she does your bookkeeping, but she can tell you how to do it and direct you to get a bookkeeper or a CPA that can really stay with you in your business. International trade, we have a specialist for that. So if you're doing trade, if you're exporting, the government helps you tremendously to export. They love that we manufacture here and we sell all over the world. It's more export than import that we're really interested in, right? Because it's our business that we're trying to do and move forward and bigger. Technology development, we are Stony Brook University. We have centers for wireless information technology, advanced research, all kinds of interns and people that can help in that area. And of course, digital marketing, which is a huge topic. Everybody's into that. And it's become such an industry on its own that it's almost impossible to do by yourself now, with the exception of just posting on Instagram and Facebook and LinkedIn, all of that. So this is what we do. And please, at the end, there will be contact information. If you're not a client, you want to become a client, Leslie is on the call here. She is your front desk manager. She will get you a good, convenient appointment. We do our appointments by Zoom or also on the phone. So it's very convenient. Don't have to leave your office. We can see you and talk to you and stay with you all the way. So I welcome you. So let's talk today about lending. When does that come up? Well, everyone's going to say everybody needs money all the time. We all need money. Yes, it's true. You have to have money to survive. Whether it's your own money or borrowed money, you're going to need access to capital if you want to do a business. Some people come to us, they are now going to do a second location. Maybe they're going to be franchising and they need money to get started on that. Maybe they need to update their systems, their equipment. That always happens over time. Maybe they know what they don't know and they say, hey, I need money. I got to get a marketing plan and a website and a Google ad campaign that really drives the business to me. And I can't do that myself. I have to hire someone for that. So we can help you locate somebody that might be able to do that, or at least give you the components of what that looks like. Let's say you want a new revenue stream. Let's say I'm a seasonal business and I've got the season all going great, but what can I do in the winter? We can kind of brainstorm with you on that and help you get that going. The big one here is commercial real estate, because all businesses on their bucket list want to own the building that their business operates in. So at some point in the future, that may be on your bucket list, and we can help you navigate the financing for commercial real estate. We're very well educated on the SBA options that are out there. The government really tries to help business owners. So they have specific programs that are sponsored by the federal government through the Small Business Administration. They have guarantee programs. So the bank actually does the loan, but the federal government gives an insurance policy saying if this riskier business doesn't do well, we will come in and pay for part of that loan. Of course, you'll always owe to the government in the end. But the point is they open up the door so that you're able to get that financing. And that's really important. Business acquisition, we get a lot of these, actually. A lot of baby boomers are looking to leave their business behind and want to give it into capable hands. So many people come to us and they're looking for financing to take over a business. Some people are actually working at that business, which is awesome. And they now have the opportunity to buy the business that they work for. Other people are going into a whole new type of business and wondering if that's the right move. So there's a lot of due diligence that comes with getting capital, and whether or not you want to take that jump into an actual commitment for a loan, which is what it is. And of course, starting a business. Everybody out there thinks that there's a lot of money available to start a business outside of your own money. And actually, only about 14% of businesses get money from banks to start a business. Why is that? Well, that's why you're here, right? Because I'm going to tell you, there's a lot of risk. There's a lot of risk when you start a business, but you got to mitigate that risk and you have to think it through. And that's what we're here for. We do due diligence just like the bank does on you. When you file a loan application, they are doing due diligence to find out what the true story is and whether or not they're comfortable with giving you money. I always say, this is a very common thing for us to say, if someone came to me and said, hey, Willa, I need $50,000. You have $50,000 to lend? I would start asking questions, and I think you would too. Like, really? Do you pay your loans back? What are you going to use the money for? How are you going to get the money back to pay me? And you start drilling it down to get more comfortable with giving that money. That's all lenders are doing. They're not big bad guys. They're actually partners in your business, and they're carefully scrutinizing whether this makes sense to them. Let's talk about the products, the main products people look for. Introductory level business lending is a business credit card. I'm going to talk about the Chase Ink card, but there are lots of them out there, but Chase does have this introductory credit card. And what that does is start your business on the journey of standing on its own as a borrower. And just like if any of you have children in your life, when you raise them, you put a lot of money in and you support them. But one day, hopefully, all the cards fall right, they're standing on their own. And they're going to be their own borrower, and they're going to get their own credit. This is the same thing with a business. A business is your baby. So you get that business started, you feed it a lot of money, and eventually you want to go to a bank and say, I want the business to get a credit card in its own name, not in my name. Now, be aware that a business credit card in the beginning is going to be based on your credit, because your business doesn't have credit yet. So your personal credit score is going to be key in getting this first step. And of course, what you want to do with a business credit card, if you do get one, is have very good behavior, right? So if you charge something, you want to pay it off as quickly as possible. You want to keep the exposure on that card as low as possible so that your credit is not impacted personally and your business credit starts to become more established. The second one that everybody thinks of is the line of credit. Well, why can't I just pay interest only on my money? And that's a great idea. I'm going to go to my bank and ask for a line of credit. It is, in theory, a really good idea. But just like a business credit card, the line of credit is actually one of those that you have to pay, and you get the money, you pay it down. It's just like an advanced business credit card. The difference is when you start to get into the higher loan amounts for lines of credit, they start to look for collateral, right? So they want to see, well, okay, now you're borrowing $100,000. Is this going to be secured or unsecured? The business credit card is often unsecured, except for a lien on your personal business, on your business. So there's a UCC1 lien often filed, not always with a business credit card, but a line of credit for sure. Now you're getting into a more mature business. Maybe the business has been around longer and starts to have receivables and inventory. And the bank, we'll talk about this in a few minutes, but the bank looks at your financials and tries to see the probability of you being able to pay this down. Most banks also require that you pay down that line to zero or maybe by half of the outstanding balance at least once a year for 30 days. So be aware that there are more restrictions with a line of credit, but it's a great thing to look forward to getting because it shows that the bank has an experience with you, a history with you, and now they trust you to manage a line of credit. Lines of credit in banks are usually reviewed annually to see what kind of behavior is going on here. If you're treating it well, they will renew it and maybe even give you an increase. So that's a great way to start to establish really good credit. Term loan. Why would we have a term loan? Well, a term loan is just like a car loan, right? It's principal and interest payments over a specific period of time. So a term loan is going to be for a piece of equipment or something specific that you're buying and you want to stretch the payments out, and you don't want to pay interest only because you really want to pay down the loan and start to own it. So those are possible out there. There are SBA guaranteed term loans called the 7A loan you may hear of. These are very common, and banks feel somewhat comfortable doing that. They may not give you a long term. It depends on what you're using the money for. Like if I was buying a business, an SBA loan for purchase of a business is a maximum of 10 years. So that's, whatever you're buying. If on the other hand, if I do a mortgage, that's also a term loan. I could do maybe 25 years on something like that. Okay. I'm going to shut off my phone because that will start ringing. And let's talk about commercial mortgages because those are your premium term loan, right? That is backed by real estate. The banks love commercial mortgages and any mortgage really because now they have the security of an asset that they know they can sell to pay off the loan. The more money you put down for a commercial mortgage, the better your terms, the better the interest rate, the more lenders that will want to do business with you. So I wanted to talk a little bit today about the business lending team, because when you go into looking for capital, you should somewhat be aware of how this process works. We're going to take you behind the scenes and give you an idea of who you should be talking to. Number one is us, right? We're your first entry. We're going to be able to kind of connect you with banks and lenders and people that can help your business grow. Then there's the bank branch representative, the business banker, the loan underwriter, and the chief credit officer and the loan processor. So first, you go into the bank And these, you're always going to see people in there. They are in your community. You may know them. Typically, what you see when you go into a branch is the branch manager or the customer service representative on the floor. These are the people that open your accounts for you. They may also have a home equity or a residential lending person at the branch, but it's basically the branch manager or a customer service representative. They are going to do that initial intake interview with a business loan applicant, and they're going to decide, what kind of person should this person be working with? They're going to determine the size and the type of the request, and they're going to now refer it to the appropriate level of banker for the next steps. So this particular individual is not going to give you an approval. They're not even going to look at your financials in most cases and be able to accurately determine whether you can get the loan. But they do get rewarded for bringing in opportunities. So if you're talking to the bank branch representative, I always ask people, well, who did you speak to? Oh, it's a branch manager, and they said it looks really good. Well, that enthusiasm is, yes, come here. You're our customer. We want to help you. That's the enthusiasm. There has been no due diligence. They have not looked at your financial situation. So take it for what it is. They're excited to be able to help you. And that's a good thing. You want to definitely know your branch manager. I always tell people, it reminds me of a bank I used to work for, a small private bank, and the CEO always told me, when he came to this country 30 years ago, I think it was, he said the first thing he did was go to his local branch and deposit money and meet the branch manager, because he wanted that branch manager to know who he was and that he was going to be a depositor at that bank. And when you go into the branch, say hi, how are you? Get to know them, because that can be there is some subjectivity in lending. So if they know you and they see you're the pizza place down the street and they know who you are and they frequent your place, that's going to be helpful. So don't discount that. Get to know your people, mingle with the people that can influence the decision down the road. So who's next? Well, it's the business banker, right? The business banker, there are different levels of business bankers. There are business bankers that work in the branch, and they actually work with the smaller businesses. So if you're just starting out or your revenue size is under $1 million, they may be sitting in your branch every day, or they may cover multiple branches. But that's an entry-level business banker. So they are dealing with smaller businesses. They'll be able to help you get your business account started. They may be able to offer merchant services, if that credit card processing. You don't have to do it with the bank, but you can. And they have check scanners they can set you up with. There's a lot of cash management tools that they can talk to you about, so they're very helpful. Again, business banking, deposit and lending products. You may not be going there for a loan. Maybe initially you just want to get your deposit situation, get checks, do all that kind of thing. They also will interview a business loan applicant. And so they're going to talk to you about the situation. What are you? How long have you been in business? What are you looking to do? What are you purchasing? And in the back of their mind, they're thinking, is this a deal I can do? Or should I be referring it to a higher level of business banker? They will tell you exactly what you're going to need to apply. They give you a custom checklist based on your business, and they're going to be very helpful. If they do take your loan request in, often they will prepare what's called an opportunity memo, which the loan underwriter will now look at when your loan application comes in. This is the part where if you know this person and they go, oh, I've known this man for 5 years. He's an awesome customer of ours. We want to give him the best treatment. He's starting a business. He's got a lot of money on deposit. All these different factors come in. And they want to give the underwriter a personal flavor for this applicant. So that's very important to know, that if you're meeting a business banker, and honestly, at any size business, they should have an assigned business banker, because he is going to be able to troubleshoot when you have problems in the banking area for your business. After the business banker takes in your loan, then we're going to go to the loan underwriter, and they're going to do that due diligence. You're going to hear that a lot. And I always say, The loan underwriter is your best friend because they're looking at things that you may not have considered. When you get approved or denied, you should really never take that personally. You should say, wow, they found things that I didn't know about. It may not feel good to hear that you were denied, but denied is not denied forever, right? Denied is, I have some things I have to do differently to move forward and be more lendable. Okay. So they're going to look at your company performance if you have one. Most lenders are historical lenders, meaning they like to look at past tax returns. That's why startups have trouble, because they're using projections instead of historical performance, but it can be done. There are a lot of banks that do some startups with projections, so that is a possibility. And there's something called key ratio, which is liquidity and leverage and debt to income, all these fancy financial terms, but they're important and they do come from your financial statements. Your accountant can also key you in on what kind of things tell an underwriter whether you're healthy or struggling. Those are very important. The other thing they look at is mitigating factors. So what does that mean? Well, let's say I went through a divorce 2 years ago and my life was upended and it took me a whole lot of time to get myself back together. But got myself back on track. I've now got money. I've got a good job. I've got money coming in. Maybe I met somebody else and I have another source of income. So when I write up your opportunity memo, I'm going to say, a couple years ago, the credit tanked. And this is why. There was a specific reason, and since then you have turned it around. So that's a mitigating factor that would want to be noted to an underwriter. Usually an underwriter will look at your package and come up with a list of questions and then get you on the phone and ask you what those answers are to those questions. So that's always a good thing. There's a back and forth. It's a give and take with underwriters, and they're just doing their job, trying to make sure that they've seen all the red flags and they can explain them and they feel comfortable moving forward. When they move forward, they send your application to a chief credit officer. This is the person that really monitors the bank credit policy, and they maintain the portfolio for the bank. They tell everybody what the appetite is. So when I say banks have different appetites, it means some banks, maybe in their portfolio, all of a sudden they have, 50% of them are restaurants. And they go, that's enough with the restaurants. We have too many restaurants. We have to diversify our portfolio. So you may be going there just at that time when your restaurant is just added to a pile of restaurants and that's enough for them. But another bank may not have any restaurants and they may want to do it. So there's different appetites depending on the bank. And it makes sense, right? If it were your portfolio, you'd want to spread the risk across different industries. So that's what they're looking at. And they're at a very high level, but they do impact what the loan underwriter is looking for and what things they just won't do. For instance, some banks will not do startups under 2 years. So you go to a major bank like a Chase, and they're going to tell you, you have to be in business 2 years to get lending from us. And that's it. That's the way they want it to be. That doesn't mean every bank thinks that way. And our job as advisors is to try to stay very close to what the market is doing. We actually do, and the SBA, we track where our people are finding money. Okay, so it's different times, different years, that changes, and we try to keep a good sense of where people are getting money and what the risk policy is of these different banks. The last thing is, if you're lucky enough to get a loan and you're going to go to closing, you're going to be assigned a loan processor or servicer, and they're going to tell you what you need for closing. They do a loan agreement, and you want to look that over with an attorney or your accountant, make sure that everything looks good. There's usually some conditions on there that you want to check out. And then every year, they're going to reach out to you and ask for your tax returns and make sure, and then they're going to look at the tax returns, or an underwriter will look at them, make sure that everything looks like you're still trending in the same direction as when you first applied. Okay, so any questions yet? We're good?
We're good.
Okay. So now we're going to apply for business financing. And as this lovely little emoji says, you only get one chance to make a first impression. So I always say, don't just go out there and just apply to all these different banks. First, you want to get your ducks in a row. You want to make your application look as strong as possible. If you're a startup, you want a good business plan, you want financial projections. And these are all things that we can help you put together so that you look the best that you can. I should say that all banks want to lend. They just want to lend to the people they want to lend, right? There's an old saying that people want to lend to people who don't need the money. A little truth to that. You know, if you're coming from a good place and you have saved your money through the years and you're ready now to make that jump into entrepreneurship, they like that. They feel like you've really, gotten yourself together, that you're not just quitting a job and deciding to do this because you think it's going to make you a lot of money. You've really thought it through. So it's important that you have a good first impression. So what are we talking about in the loan package? First of all, your last 3 years of tax returns will be required. There is also what's called a personal financial statement. That is basically the balance sheet of your life. What you own in life and what you owe in life is measured against each other, and hopefully the bottom line, or the amount of money you have and the assets you own, if I subtract out all the debt, I have a positive number. If you don't, it's going to be very challenging to get loans unless you have some sort of mitigating factor that the lender is okay with. If you have a business, they will ask the same thing of the business. Last 3 years business tax returns. If we're in the middle of a year, let's say it's June and you haven't filed for that year, they're going to ask for a year-to-date income statement and balance sheet, and possibly a cash flow statement as well. There is a form from the IRS which the bank will require you to sign, and what that does is they send that form to the IRS, and the IRS sends them a transcript of your tax returns and compares it against what you submitted. So why is that? Because people do fraudulent things and they make bogus tax returns thinking, oh, bank's never going to check this. They do. They check it. They get it. And if it's not the same, you're pretty much dead to them for a long time. So don't do that. Make sure that it's your real tax return and that you really filed it. Because honesty is a big thing, and it's very difficult to go back and change that if you're doing that up front. There's also what's called a business debt service schedule. And this is basically all of the term loans that you own in your life. So let's say and on the business only, not you. So at that point, you're going to want to put together a schedule of any loans you have that are principal and interest payments. Maybe you have machinery in your store, or anything, any commitment outside of utilities and things like that. You're going to put that together because that's going to be used to determine your cash flow. So let's talk about the business plan really quickly. This is something that it was just drama to try to get people to write this. I don't blame you. It's really a lot. People think, oh my God, I have to write a business plan. Well, the nice thing now is we have a little AI assistance that has been very, very helpful. So a lot of times what I will do is work with people. We will get a draft of a business plan going with, let's say, ChatGPT. And that's not going to be your final plan, but it's going to get you started. And it's going to be very helpful to organizing your thoughts. And when you do the whole business plan, at the very end, you're going to create an executive summary that gives the underwriter a really quick synopsis of what you're trying to do. It's going to have little parts from the plan all on the first page, because a lot of lenders don't actually read the whole plan. Isn't that terrible that you took all that time to write it? But it's good to do anyway, because it's good for you. You need to have this plan for yourself as well. But if you're going to a lender, that executive summary in the beginning is very important. That's your first impression. Part of the plan is a company description. Are you, again, an LLC, an S corporation? When did you establish yourself? Who's the owner? A little brief bio of the owner. Attach a resume to the plan. The market analysis, where are you locating this business? Have you looked at the demographics? Is there a demand for what you're doing? What kind of research have you done to make sure that your business is going to be successful? Organization and management, who's going to run the business? Are you going to be there every day? Are you hiring a manager? Who's doing the books? Who's doing the sales? Usually, if you're a partnership, I always say that there's got to be one person that does a lot of the financial part of it and one person that does the sales. If you're an entrepreneur, you are a salesperson. So let's just put that on the table. You are constantly going to be out there letting people know about your business. Your passion is going to shine through. So most entrepreneurs come to it with a sense of sales. You have to be able to meet, network, get to know people, tell people about your business. That's a very big part of it. But this would also be staffing. If you're a retail store, what is your hour? What are your hours? Why are you deciding to do those kind of hours? Maybe you're seasonal. You've got to talk about that there. Next part would be your service or your product line. What are you selling? What are you doing? That's pretty straightforward. Marketing and sales, that's more the digital and maybe it's print, but how are you getting your message out there? And usually we put a timeline of how that's going to go. We try to think about, and again, AI is very helpful on this. They can really break this down for you and show you what a good sales strategy would look like. And then you can customize it. I always say you're adding the salt and pepper to the plan, right? You want to season it with your own knowledge. Lastly, we have the funding request. How much are you looking for? Remember that you have to put money in too. You have to have skin in the game. The bank is not going to do 100% financing of whatever you want. So they're going to want to see how much money are you putting in and how much are you asking from them. And then the final thing is really the financial projections. What are those? Well, it's the money you expect to get in every month, as well as the expenses of that business. So when you start the business, if it's a retail store, you're going to want to know what the lease is, what the utilities are going to be, what's your inventory. All of that is going to have to be kind of broken down so people can easily see, okay, if I'm running a restaurant and I need $10,000 a month to cover my expenses, break that down for me. How many people do I have to serve a day? And figure that out. How many table turns, as they say in restaurants, do I have to do? All of this is for the lender and for you. It's really, really important that you have this. I have to tell you, I've been doing this for many years. When people take the time to do this, they become so much more confident and so much more capable as a business owner. It's a really, it's a financial risk that you're undertaking as well as an exciting time. The appendix is where you're going to put your marketing materials, your resumes, your lease agreement, anything that supports your plan and is concrete. So that's where you're going to put in your business plan at the very end. So I always say, start small, don't overcomplicate it, don't get overwhelmed. That's what we're here for. We're here to help you get through it. As I said before, with AI, it has really made it so much easier to get started. I used to give people a template and say, well, go at it, let me know when you've got your first paragraph and I'll review it. Now I don't do that. What I usually do is start with an AI generated draft, or I ask my researchers to give me a sample business plan for your industry. And we take that and we look at it and is this work for you and whatever, but don't get crazy about it. Don't let this be a blockade against moving forward. I have had people who did the plan, realized this wasn't the right time, and it's all about timing and opportunity with business. And they waited and they saved a little more money and then they were ready and they became much more successful. Focus on what your audience needs. So in the case of going to a lender, your lender needs to feel confident in what you're doing. Are you being honest? Do you really have the background to do this? How are you showing me based on your words that you've really done your due diligence. So I can be more comfortable too, because I am now going to be lending you money and essentially being a kind of silent partner in your business. Write what you know, research what you don't. A lot of people come and they're starting a business in something they know a lot about. I find that with restaurants, that a lot of people have been working in restaurants for many years and now want to own their own. And they really understand that industry, which is very unique in itself. So they know a lot. And I tell them, put in what you know, and then we'll get the research for what you don't know, and we can add to that and make it better. And remember, it's not just about getting funding, it's all about you. It's clarifying your business idea for yourself and your business partners. It's a roadmap and it lives with you. You're going to go back to that plan someday and say, oh, I was going to do that. I was going to do this. That didn't happen. This happened. As you expand your business and grow, and all businesses really want to grow, this is your starting point. This is what you're going to build on as time goes on. I put this in here, this Equal Credit Opportunity Act, just so you know, because I get a lot of questions. How long does this take? Well, it really is governed by how quick you are to give them a complete package. So there is Reg B, which has a 30-day rule. It's the Equal Credit Opportunity Act. And it says once the application is determined to be complete, meaning everything is in, the creditor or lender has 30 days to notify you of your credit decision. It protects applicants from discrimination. It covers the actions of lenders before, during, and after a credit transaction. And again, the more complete going into underwriting, the faster the decision. So that's why we always look through the package, make sure you have everything. And your business banker will also be doing that before he or she sends it forward. Looking a little bit at the application process flow, it goes through underwriting, and then they're going to review the package, look for missing information, also ask questions, do a little financial analysis, sometimes decline very quickly. Mostly the personal credit score is a big reason why people get declined. So you want to make sure that your personal credit is as best as it can be at the time of application. Or you get approved, you go to post approval, and then you go to closing. So now we're going to talk a little bit about the commercial loan underwriting. So it's, again, talking about your honesty and your credit worthiness, which is really important. It helps the lender determine the level of risk involved in providing funds. It also performs due diligence, which is what we were talking about before. They're doing homework on you. They're going to look you up. And, by the way, they all do Google searches. So make sure you're doing the Google search yourself on how you appear online and what's going on in your world. There are 4 things that are really about risk. Number 1 is they want to reduce the risk. So if you have a lot of risk associated with your application, they may require more money down. They may want you to put more investment into the business. They may want a stronger personal guarantee. So let's say your credit is terrible, but you can take on a partner, and that partner can add strength to the application. So that would be ways to reduce it. To transfer risk, that's where collateral comes in, right? So if I can put a lien on your assets or your collateral, I'm able to transfer some of that risk onto something else. Makes me feel more comfortable. They may have to accept some risk. That divorce that I was talking about from 2 years ago, now I've given them a reason why they're seeing a little bit of a blip on the radar screen about my past, and I can explain that. Maybe I had a health problem and that took a lot of money out of my account, but now I'm back on track. So I can accept that. That makes sense to me. And then avoiding risk altogether is really you're too weak to approve at this time. There's no appetite maybe for this industry in their portfolio. So these are the 4 things that really go into evaluating the risk. And it's all about risk management. And really what they want is for you to pay back the loan. That's the bottom line on all of this. So we're going to go into that. So every lender is thinking, I have to have three ways out. So the first way is cash flow. Does this business have the ability to pay back the loan? And I'm going to evaluate your tax returns, and I'm going to see how much money is available from this business or this person to be able to start this business and pay back the loan. So cash flow is very important. Collateral is, what are you putting up to secure the loan? Now, when you do SBA financing, the SBA requires any and all collateral to, so a lot of times they're going to say, and you're going to hate this part, but you're going to have to put your house up as collateral. If it's a large amount of money, they're going to put a lien on your property. It will come after your regular mortgage, but they want to have that lien on there. So if you default, could they come after your home in that case? Yeah, they could. But if you start saying, no, I don't want to do that, I want to put my house up, whatever, what is that really saying to me is that you don't really feel strongly that you're going to be able to make these payments. So be careful about those kind of conversations. You can tell us that, but if you go to a lender and you say, I'm not putting up anything, I don't want to give a personal guarantee. If you're a young business, that's not going to be an option when you're looking for money. I have done deals that maybe are $1 million, and the one that most recently comes to mind is someone bought a business. It was $1 million, had a lot of goodwill in that purchase price. What is goodwill? Goodwill is the business has been around for 30 years and has a client base, and everybody knows it. And so it's not a tangible thing that I can actually get if the loan defaults and I'm lending $1 million. So what would make me more comfortable? Well, this particular applicant had a lot of investment property. They put liens on every single investment property, which was very surprising to me, but it made them comfortable, and that was the only way he could get the funding. And he was like, listen, the worst that happens is I have to sell one of those investment properties and make the payments, and I can do that. I'm willing to do that. So he really wanted to do this, and that's sometimes what ends up being in the negotiation. But collateral is an important thing. Personal guarantee is the third bucket. How strong is your personal situation? How's your credit score? What they have found historically is that the way people treat credit as a person is the way they treat credit as a business. So if you are someone who pays everything late, who leaves people in the dust, if banks have charge-offs, what a charge-off means is that you're never going to pay them back and they had to write it off their balance sheet, they will never lend to you again. Okay, so credit is super important. We have a workshop done by a credit consultant that has been very, very good. So you can check it out if your credit is not good, and he'll help you get your credit in a better position. But it's really important because it's being used for everything now. Even when you go for insurance, they're checking your credit. So it's something that is a driving factor in credit these days. So these three things are weighed, right? So if you have not such great cash flow, but lots of collateral and a great personal guarantee, that could be offsetting, right? It might be able to be okay. If you have terrible cash flow, no collateral, and a weak personal guarantee, you're probably not going to get the deal. But these three things, always remember, in the mind of a business lender, this is what they're thinking. How's the cash flow? Where's the collateral? And can I get a personal guarantee? And what does that look like? Does that person have money in the bank? Have they been able to save through the years? So it's not usually one single variable that drives the decision, but a combination of these variables. And I should say that also on the cash flow side, they look at the business, but they also look at your personal. So if you need that business to run your personal life, that's going to be considered. They do a business cash flow and they do a global. And we're going to talk about that next, which is what kind of calculation is done. So they're going to look at the annual business debt, which is the current debt of the business and what you're proposing to take on. They're going to look at the monthly payments that you owe, and they're going to multiply it by 12 to get your annual business debt. Then they look at EBITDA. What's EBITDA? Well, they look at your tax return and they look at your net profit. They add back interest, depreciation, and amortization, and they get a number, and that's an annual number, and they divide that into the business debt. And they get a debt service coverage ratio. So that's the business debt service coverage ratio equals the EBITDA divided by the annual business debt. Now, in simple terms, because this can get a little squirrely to understand, if I have $100,000 of annual business debt and I have $125,000 of EBITDA, meaning I'm making net profit, interest, depreciation, and amortization, I have a little bit of a wiggle room, right? I'm not 1-to-1. I'm 1.25 times the amount of debt I have. So in your personal life, they call it living within your means, right? You don't take on more debt that you can pay. So they look at the income coming in to the business and whether or not, and the personal, by the way, they do the business only, and then they do the global, which is including your personal. So let's say I'm married and my husband takes care of all my personal expenses. He's got good income, but I'm the one that's going to be the business owner and I don't. They're going to look at that. That'll be a mitigating factor, that you have somebody that is taking care of your personal and the business. You're not going to rely just on the business to run your life. Because the most important thing is your personal situation is always going to be paramount in your life. If you can't afford to live personally on what you're bringing in and you're expecting the business to do that, that's going to be a high risk, because we don't know if it's a startup. We don't know if that business is going to be able to do that right away. And usually it takes a couple of years to get to the point where you're at a break even. So you're going to have money available to get you to that point. So the bottom line is, does the cash flow support the amount being requested? Any questions at this point?
Oh, yes, we do. I have a funny feeling we're going to have to do them afterwards, but I'm going to start. Diana is asking about the financial projections appendix. What kind of proof is necessary? And are there any footnotes, quote unquote, that are either red flags to the bankers or something that they look for to make sure we know what we are talking about?
Right. So that's a good question. Thank you very much. The projections for an existing business are the easiest, right? So I already have a business. I know what I'm making every month. I know my expenses. I use QuickBooks. I know the money coming in. I know where all the money's going, and I have an accounting for it. So when I want to expand, or let's say I'm going to expand into the space next door, and I have a restaurant, I'm going to expand my restaurant, and I'm going to add 10 tables, right? I can kind of figure out how much money I'm going to make from those 10 tables, depending on the time of day, and maybe weekends I make more money, all that kind of stuff. So we do a little calculating, and there is some subjectivity to projections. But on an existing business, it's fairly simple because you already have the fixed operating expenses. You know what the new operating expenses are going to be, hopefully. You have to do some research. If you're going into a new space, they're going to tell you what the rent is. PSC&G is going to tell you your utilities, what they're going to be. You're going to meet with vendors. They're going to tell you what your inventory is going to be. And all of that goes in the projection. So you will have some specific factual information. And some of it is going to be realistic but optimistic. Okay. I should tell you that there are studies out there. I think it may even be on the next page. Nope. But there is a study out there called RMA, Annual Standards. So what it does is it takes results from, let's use restaurants, all the small business restaurants out there under a certain revenue size, and it kind of figures out how much do they pay as a percentage of revenue for utilities, for inventory, for staffing. And they have an average number that the underwriter can look up, and we can look up with you too. So you have some guideline as to whether you're in the ballpark or you're way out of, when people come in and they think they're going to make $100,000 in revenue in the first month, that you have to have some factual basis for. I always say to people, you got to hit the road running, right? So if you're going to start a business and you've got a huge following of people and they're all like clamoring for you to get going with your business, that's something you want to tell in your business plan so that the underwriter understands where those numbers are coming from. There's always going to be, as you were saying with footnotes, an explanation. How did I come up with that? What I do is on the projections at the bottom, I'm going to put important assumptions. So for instance, if I have an SBA loan for $100,000 at 10% over 10 years, that's what I'm looking for. There's going to be a line in my projections, and I'm going to explain down below, this is for an SBA loan of 10 years at 10%, and that's where I got the payment from. So if you can explain where you got that from, you put that in those important assumptions. So someone's reading it and they go, what is it? Where did she get that number from? Well, you know, that's where I got it from. And sometimes people will have weird leases. Like I've had a lot lately where the first 6 months of the lease are free and then it kicks in 6 months later. So on the projections, the first 6 months you don't see any rent, and then all of a sudden 6 months later, on the 7th month, you see rent. You got to explain that down in your important assumptions. So this is what we get into. It's, you know, not cut and dry. Everybody's a little bit different, but there is a way to do this, and we're all trained to help you understand it. I hope I answered the question.
Well, we'll find out, but she's got some other questions, and I hope Diana can stay for the entire workshop. She has some questions about credit score. Number one, this is one that you and I have discussed in the past. If accessing a credit agency in and of itself is a ding, are there any tricks to avoiding that self-fulfilling prophecy? B, I'm going to give you all three of them. If you've been recently declined for a new credit card, is there any reason to take a next step until the 2 years are elapsed before we're back on track? And C, what is a good range for FICA? It sounds like we have to be at least 700.
No, 640 is the minimum in most loans. I don't want to get too far into the weeds on a credit because that's not what this is. You know, it's not a credit. We do have a credit workshop where you can watch it or reach out to that individual because he's an expert in that. But I'm trying to remember all of the questions that you just gave me.
Okay, I'll go back to B.
I may answer it though. I am going to
go
talk
ahead.
a little bit about it. So let me just go forward a little bit, okay? And let's see if I don't answer it, I'll come back. Collateral, I just wanted to talk about on loan that we talked about this a little before, but if you have accounts receivable, they're going to look at 80% of the amount under 90 days as collateral. And that it's what can convert to cash. So that's how they determine the size of your line. Inventory, they'll take 50% of that as a value, as something that could be converted to cash. Equipment, they're going to look at the useful life of your equipment. Is it 20 years old? Does it have any value? It's not enough to say I have a refrigerator. If the refrigerator is 20 years old and you're going to have to replace it soon, that's not really an asset that I could say could be quickly converted to cash in the case of default. All of this is in the case of default, right? That's what collateral is for. If you don't make your payments, what do you have that you can liquidate to make your payments? And with real estate, it's the same thing. How much are you putting down? How much equity is in the property? Will you be able to convert this? And this is with real estate, it gets tricky because, like, let's say I own a gas station. And I don't make my payments. And now the bank has to come in and liquidate the gas station and look for a buyer. If you think of it logically, there probably aren't as many buyers for a gas station as there would be for an office building, right? Because there's a bigger market of people that would buy that, whereas a gas station has a lot of environmental impacts, and a lot of people don't want to own a gas station for whatever reason. So they do think of the type of real estate too when you come to collateral. And again, shortfalls, if you don't have enough collateral, there may be mitigating factors. So if it's a secured loan, and any big loan is going to be secured in most cases, does the collateral support the amount being requested? Your personal guarantee. So there's personal net worth. Is what's liquid? Liquid means I could go to the bank today and get the money out and use it. Illiquid is things that are frozen, like real estate. That takes me a while to liquidate. So it's kind of fixed. It's out there, it's an asset, but I would have to go through a process to get the money, and it's not immediate. So they want to look at the propensity to provide funds to business when needed. Do you have skin in the game? If you're asking a bank to put all this money in, what are you putting in? Because it's your business and you believe in it. You should believe in it more than anybody. So they're always going to look for skin in the game. That's where it comes back to that lien on your personal residence, your personal guarantee. That's your skin in the game, and your personal credit score and your repayment history. So how much support does and can the guarantor provide? Here we go. I knew there was a slide on this. Factors impacting a credit score. History of repaying money you borrowed. If you are not repaying money you borrowed, or have slow payments, late payments, you're going to have tough time getting more money from a business loan. Personal is a little more lenient than business. People are always surprised that the rate of business financing is much higher than you would see on the personal side. That's because there's always more risk involved. You could walk away from your business and say, I'm done with it. I didn't give a personal guarantee. Good luck. There is more risk. You don't usually walk away from your home that easily. If you're living there and you need that place to live, you're going to do everything you can to keep your home. Not as much with a business, unfortunately. The types of loans you've had. Have you had principal and interest payment type loans? Have you bought a car and do you have a mortgage? Mortgages are real hard to overcome if you're bad with them. Like if you're late on your mortgage consistently, don't go looking for a business loan at that time. It's just not going to work, because they're like, she can't even pay the mortgage on her house. That always should be the first thing that comes out of any money you get, is your mortgage payment, because that is the king of financing, if you will. How long have you had a particular line of credit or loan? If you've had it for a lot of years and your good behavior shown with that, that's going to be very positive. How much total debt you owe versus what is available to you. So this impacts the score. So if I have a $5,000 available credit card and I'm only using $500, that's 10% of 5,000. That's good. As long as it's under 30% of the total amount of the line, that's going to impact you positively on your credit score. On the other hand, if I have $5,000 line and I owe $4,500, I'm almost maxed out. If I'm maxed out on all my credit cards, that's not good. That means I'm allowing that to build up and I'm not paying it down. So remember that lines, really the behavior is what they want to see is, sure, take the money, but pay it back, and pay it back regularly. At least make minimum payments. Very, very important. Do not get lates. And if you do, you have to have a good reason for it. Again, if you had a medical emergency, you had to tap out your line, and then you can show that 6 months later you finally paid it down and you were able to get out of the clear. That's what's really important. As far as the report itself, I think part of that question was, should I find out what my report is? You can go to the annualcreditreport.com, which is the federal free credit report. I urge everybody to do this. It's not going to give you your score. I think you can pay for the score. It's like $10 or $15 to get the score. But the most important thing is it gives you the report. So you can see what the lender is going to see. Have you been late? You can see on that report how many times have you been late. A lot of the banks also give free credit scores now. But when you go to a bank and you apply, many banks will tell you they're going to do a soft pull. A soft pull does not impact your credit score. If you apply and you move forward with that bank, they're going to do a hard pull that does impact your credit score. Okay, so when you go to a bank, they can see who has pulled your credit. So if you're bouncing around between bank and bank, I'm getting nervous as a lender because I'm like, oh, this person is just out there. You know, they're not serious. They're getting declined, 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 declined. Now they come to me. No, doesn't feel right. So think about how, this is what this whole workshop is about. Think about how the lender is looking at this. And it's really common sense when you think about it. They're lending you money. They want to get paid back and they want to feel comfortable with your payment history and that you've been serious about paying back your money. There are 5 C's of credit. I always bring this up because it's something everybody talks about, but we've talked about most of this. Credit, your personal and your business credit. If you have good character, you're going to pay your bills on time or at least make minimum payments, and you're going to live below your means. So if you have $1,000 coming in every month in your life, you're not going to have payments of $1,500 a month because that's going to immediately get you behind the wheel, right? Behind the bad part of the wheel. So keep your credit good as best you can. If you're in trouble, find ways to repair it before you go for financing. Capital, your own money. What do you have? Are you able to save? Are you just spending every dollar that comes in? I know we're in a tough economy and it's really hard to save. It really is. I always recommend that people have money automatically taken out of whatever income they're getting and thrown into an account so it's not available to you and you live with the rest. Someone told me this when I was like 20 years old. Take 10% of whatever you make and put it in an account and just have it automatically go there. And it's amazing how quickly that adds up. And then I never get used to having it. I don't even know. And then I open up the statement and I say, wow, that really added up fast. It does. That forced savings is really a great idea. It's back in the day, they used to call them Christmas clubs and holiday clubs and, where you put a certain amount in at the end of the year, you have this money. So any way that helps, there's actually a lot of online apps now that also help you save money like that. So it's really helpful. Collateral, think of the quality of your collateral, the type of collateral, and the useful life of that collateral. The conditions, do you have a good business plan? Is it a good economy to lend money to? Sometimes the banks will pull back. And by the way, most banks, they have a ratio between deposits and loans. Remember, when you borrow from your bank, you're actually borrowing money that your neighbor put in the bank, right? So they also don't want to lend more than their deposits. There's often a ratio of 4 to 1. So they have 4 times as much deposits as loans. So that ratio is different in different banks, but there is a logic behind it. They don't want to get to the point where they have less money to loan than the amount of loans they have on the books, because that's how banks fail. And then the last is the general impression of the borrower. If you come to me and you're opening up a restaurant and you have been in a restaurant working for 10 or 15 years and your credit is good and you've purchased a home, it's that Maslow's hierarchy of needs, if you know what that is. I should have a slide for that, where the bottom foundation of a life is that all your personal needs are taken care of. Then you move up the ladder to add other things to your life. So if you have your home, or maybe you don't own the home, but you can rent, how you have enough money in your life to take care of your personal things, that's when it's a good time to think about investing or starting a business and doing something different. So what is the overall positive impact? Again, years in business, amount of deposit balances at the lending bank. Now, there are some, we'll talk about that. The bank that you put your money in should be your first go-to, because they should have some feeling of, I want to lend to my own customers, right? So most banks feel like if you're have been with them for a long time, they're going to try to help you. Strong sales revenue, again, they're historical lenders are mostly looking back and saying, what has happened in the past? Have they reported increasing revenue year over year is very positive. Strong credit bureau score and having some collateral. What's negative? How much debt you have against how much you have in assets in your life. Excessive number of recent inquiries. That's what we just talked about, where you're going place to place to place looking for money and it's dinging your credit score. Prior bank charge-off or currently delinquent, it's not the time to go look for money. And I know that's probably what you need, but you know, we always tell people there's friends and family, and if that's not it, then there's second jobs. I know this is harsh, but unfortunately we get ourselves in trouble. And we do have credit counseling people that can help you kind of look at that and really do. The guy that I'm thinking of that did our last workshop was just amazing. He himself got in trouble in his life and he learned how to repair his credit. That's what you may need. You may need somebody like that to help you get out of in the clear before you go and look to apply for financing. External delinquencies or negative credit bureau information needs to be explained. High-risk properties and industries are just going to be out there, as some properties and some industries, banks or lenders just stay away from. They don't feel comfortable with them. Let's think of like a Blockbuster. Would you invest in a Blockbuster now? No, because it's you know, it's not around anymore, right? For the most part. But when that was on, you know, when that was starting to go down, banks started pulling back from financing Blockbuster franchises because they saw the trends. And it's very important, you know, futurists, they are specific scientists that look for what are the trends? Where is this going? You know, when we talk about AI is going to have a tremendous impact on small businesses going forward. We can either choose to stick our heads in the sand and say, not me, or embrace it and say, let me be the forward mover in something that looks like it's going to make a difference. And that's where, you know, entrepreneurs have to take those, you know, those trends and build them into their businesses so that they're always going to be current and be in demand by the customers they're trying to attract. Business losses year over year are very troubling. COVID was a very tough time for businesses. So for a couple of years after COVID, we saw a lot of businesses with a lot of losses. Now we're a little bit beyond that. So it's great. Banks are seeing that they've managed to get through the tough times and they're getting better. So that's a way to mitigate some of those losses. Alternative funding options. Remember, we keep talking about banks, but there are online applications, quick turnarounds, funding usually within a week. They will accept less than perfect personal credit, low time and business requirements. Some feature no collateral. You can compare several loan offers all at once. But what do you think? I bet if I had you in a room right now, I'd say, what do you think is the downside? And the downside is usually the repayment is less than a year or 2 years, which means your payments are very high. It's a high cost of capital, high origination fees to get the loan. The annual percentage rate on your interest can be 9 to 80%. I know that sounds unbelievable, but is true. Typically, they will pull daily or weekly payments from your checking account. And there are some online security concerns. So before you go to an online lender, you might want to check with us or let us do some research to make sure it's legit. There are a lot of online lenders that surfaced during COVID that are no longer in business because there was a lot of fraud going on. The other side of this is the online lenders sometimes don't have real people to talk to. Very hard to get people on the phone. Something to think about. So let's be safe. Let's protect ourselves from predatory lenders by looking for warning signs. They may have unfair and abusive terms, deception, coercion. A lot of our advisors, we have like an internal communication thing where they go, hey, has anybody heard of this lender? And everybody will put their feedback in. So we do have like kind of some anecdotal information that we know about certain lenders. We do also have online lenders that we think are pretty good, and we would tell you about those as well. They typically have higher interest rates, sometimes not. If they're SBA lenders, there is a maximum interest rate that they can charge. But be aware if the fees involved are more than 5% of the loan value. Make sure you know what the annual percentage rate is and the full payment schedule. Don't lie on your paperwork. Don't leave signature boxes blank. And certainly don't get pressured into taking a loan. And if your credit is really bad, again, maybe not the best time to take a loan, and make sure you have a way to repay it. So some final thoughts. Passion needs to be supported by facts. One of our questions today was just about that, right? So yes, you do have to do some research to do your projections. You can get very excited about opportunities, but what our job is to let's look at what you're looking to do. Let's see if it makes sense. A lot of people, it does make sense. And so we're going to help you move forward. Other people, I say, let's think about whether this is the right time or the right opportunity. And you may want to think that through because you're taking on a big financial commitment. Complete loan packages rule the day, meaning get everything together before you apply so that your decision can be made as quickly as possible. Declines can be a good thing, right? If you are declined, it feels terrible. You're like, what am I going to do? Find out from the lender why you were declined and look to improve that for the next opportunity. And remember that relationships still matter. So back to the beginning when we talked about the banks and walking in and getting to know the branch manager, those relationships do matter. And, networking is huge for entrepreneurs. You got to know people to do business. It's really important. And entrepreneurs are, in essence, they are salespeople. They're out there trying to tell people about the wonderful business that they are running, and we need you out there. So we want that to be a big part of what you do. How do you contact us? Well, we've got these cool little QR codes that if you all want to shoot it with your phone, you can get all the information you need. And Leslie is our front desk manager. She will get you an appointment, and we have interns that also answer the phone. So we're here for you, and we want to talk to you about your business. Any additional questions, Leslie? Do you have?
Yes, I go back up here. Maria had a question, but I think I answered that for her. Oh, we're asked if your collateral is not owned only by you, for instance, home ownership, then is it still possible to use it? And what is the impact? Is it 50% of the house?
No, they can put a lien on your property. I, hmm, that's a good question. Let me think about that. Because most business owners are just, they're married. They have other people there, and also, usually it's a positive thing because you have another owner. It depends on the size of the loan, I would say. And again, the type of business. Is it an existing business? They probably wouldn't even put the lien on it if there is some collateral already available. It would be a credit decision whether or not they wanted to put the lien on the house. Your husband or wife or significant other that owns the house with you would have to sign off on that lien. Otherwise, depending on the risk situation, they may not do the loan. But sometimes they can waive that requirement if everything else is very strong. But yes, whoever is the owner of the property would have to sign off on putting a lien on the property. That would be my answer. Leslie?
Okay, yep, I'm still here. Okay, Antonio, SEEP, well, first of all, people are asking, what is SEEP? SEEP is the Self-Employment Assistance Program through the Department of Labor. It's a special program when you're collecting unemployment benefits, whereas they do not require you to look for a job. They have a very scaled and scheduled program for you to follow in order to start a business. And yes, if you're a client of ours, we will help you do that. So Antonio, contact me after this workshop, and you can send me your paperwork. And if you're not already set up with a business advisor, I can help do that with you as well.
Okay, any other questions? Leslie?
No, I don't think so. I think we got everyone's. Wow, Willa, that was fantastic. That was
Good. Thank you
chock-
very much.
okay.
Listen, everyone, there's always hope on the horizon, right? We can't build a business just on hope, but you have us. We are your advocates. And I should make it very clear that we don't support any particular bank. And that's what's great about us. We're kind of objective. We see things, like a lot of times I get referrals from banks and the bank doesn't really want to do that. So I go, well, if it's okay with you, I'm going to shop around and see if I can find a place that would accept this opportunity. And that's because I have a banking background, I can do that too. But we are always on your side. So when you come to us, we are your advocate. We are here on a consistent basis to help you drive the economy. And that's the most important thing of what we do. We want you to be successful. So I don't want to put people in a position where they're struggling every month to make their bills. We want to make sure you're in a healthy situation, you can make a good go of it, and you're well funded so that if you get going, you have a good chance of surviving. Because otherwise, what happens? You come back to us a year from now and like, oh my God, I owe like all this money. What am I going to do? And that's a tough position to be in. So you want to do all your planning, all your strategic planning, figure it all out. And as I said at one point in this workshop, if you take the time to do this, you will be more confident. You will speak about your business in much more confident ways. People will see that you are serious about doing this. They'll want to get behind you. They'll want to support you. And that's the best of everything right there. You want everybody in your orbit and everybody you know to be on board and to help you make this the best it can be for you. And we love small business owners. So come see us. And by the way, we do have a monthly roundtable where we bring in our clients that are business owners and we sit around the table and people bring up what their struggles are or what they need help with. And I got to tell you, I am so impressed by the knowledge of people who've been in business 20 years can give to someone starting a business. We had somebody at the last roundtable, a startup, that just the whole roundtable was all about how to bring this business to life. And it was just so rewarding. So if that's something that you think you might be interested in, it's free. It's on the first Thursday of every month. It's in person. You come to our Stony Brook offices. We do have a limit to how many people we can take into that, but please be welcome. Come. Be a part of that. You will meet some great people who can, if you're really serious about being an entrepreneur, they will show you what it really means to be an entrepreneur for many years. And everybody has, you know, highs and lows, and they tell you how to get through it, and very supportive, helping others. So I'm very proud of that group, and I'd love for you to consider joining it. It's a really good resource. Okay, so I think we've got it all. Everybody, if anybody, that's it. We're good.
That's all the questions. I just want to remind everyone that when you log off from this workshop, you're going to get a survey. Please do respond to the survey. Not only is it an SBA mandate, the SBA is our sponsor, one of our sponsors, but also it helps us decide the best workshops, the most appropriate and useful workshops for you, the public.
Absolutely. Okay, thank you, everybody. Thanks for
Thank
coming.
you.
Appreciate
Take
it.
care.
Okay, bye-bye.